Good morning, guys. This is Kenzo Xtrahot Forex. So, yeah, on this topic, actually, we're going to talk about the market structure because it's very important. Very important. And if you understand, the most problem here is, or the problem actually is, it's not like maybe you don't know how to analyze or to do something. It's because you don't actually understand where to start. You see, so firstly, before we go on the structures, the best thing that you can do is understand your time frames. You see, understand your time frames. I think maybe the summary of that is bigger time frame. It's much better. As you can see, most what happens on a bigger scale. You see. But going on 15 minutes, 5 minutes, unless if you just scalping, that it's something else. Because on a bigger time frame, let's say 4 hours daily, you can easily see that, oh, the market is actually doing what? The market is actually pushing to the upside or it's pushing to the downside. So without wasting the time, let's just go straight actually to our point. Actually, we have 5 points actually. It's 5 points which I want you to go try to work those in. Actually, it's how to master Forex market structure in 5 easy steps. Some of the structures, those steps, I'm just going to talk about them. I'm not going to throw or something because some of them I just need to talk. Some they don't actually need some drawings or something, right? So let's go. Please, guys, don't forget to smash that subscribe button. Don't forget to smash that subscribe button if this information is really helpful for you. So if you have any question, you can just ask me on the comment section. So let's go straight to it. Forex market structure is the way the market moves and behaves based on the supply and demand of currencies. Even if you trade indices, even if you trade gold, we're covering that also. Mastering the Forex market structure can help you to actually identify trading opportunities and make better decisions, right? So let's see those steps actually. I just want to go through on the chart and actually tell you some of the things. I just want to make this video very quick, by the way. So identifying, the first point actually, this is the first point that you're supposed to do when you go on the market. Firstly, I said, understand the time frames, right? So on this part, I'm not going to explain much about the time frames. That will be a topic for another day, right? So the first point is identify the trend or range of market. Let me repeat that. Identify the trend or a range of the market. A trend is the overall direction of the market prices for a given period of time. It can be upward or uptrend, downward or downtrend, or sometimes sideways where the market is going to just range. This is just a ranging. We call that, it's also a trend, but the market is just going anyway. The market is just playing around. You see, so when we say identify the trend, let's say you are on 4 hours. I like to use 3 hours and 4 hours time frame. So what you can do is you can easily see that here the trend is doing what? The trend is pushing up. That is the first thing that you're supposed to do to identify the trend. So on the other side, you can see that, okay, here we have a downtrend. This is your job to identify that on a bigger time frame before you even think about doing something, because this trend help you actually to know that, oh, the market is pushing up. And we know that when the market is pushing up, we do what? We buy. So what we're going to do is we're just going to look for areas where we're supposed to do what? We're supposed to buy. On a downtrend, we also do the same thing. Once we identify the trend, our job is to identify those structures where we're supposed to do what? We're supposed to sell because it's a downtrend. I hope you understand that. So actually, some they use trend line. I use trend line. Some they can use moving averages just to identify the trend. But I think that way it's also much better. Also, drawing the trends lines, I will also come up with a video about that. Just smash the subscribe button if you still want, this type of videos. So point number two, I'm still going to identify those structures for you. I'm just going to go on these points. As I said, it's 5 points, right? So point number 2, actually spot the support and resistance level on your trading chart. I hope you understand that. Or you want me to explain? Let me explain that. So support and resistance are areas where the price trend it's actually an area where the price tends to bounce or reverse due to the imbalance of supply and demand. Support is a level where buyers are more than sellers, and resistance is a level where sellers are more than buyers. I hope that makes sense. Mostly we get this on horizontal lines, but yes, support and resistance can also be like this. The market can actually move like that. This is going to be a support and this is going to be a resistance. But on this point is, as we go from identifying the trend, now we identify, since we know that, oh, this thing is going down, now our job is to know where is this resistance and the support. I'm still going to go on that nicely with you. I'm just going to make sure that you understand the steps before I go on the chart and start to draw. You have to understand these steps. Firstly, you identify the trend. Secondly, you spot the support and the resistance levels. The third one actually is understand the price pattern. Price pattern is actually the movement. To understand that, oh, this thing is still want to continue. This is not about the support or resistance, but you can easily see that, oh, the market, it's where the market will reverse, but here it's where the market might bounce back. That is actually called price pattern. If you understand that, yes, you are good to go. So let me just maybe try to explain price pattern, because some people, they might maybe have some issues actually understanding price pattern, as they just know candlesticks pattern. So price pattern are repetitive movements that indicate the psychology of the market participants and their expectations. Mostly we know when we actually push down, let's say maybe we are on a downtrend, mostly we know that around this area the market will actually bounce back. That is the psychology of the market, because mostly that is the high. Around this area is going to be the high, so everyone is actually looking at that. And once you see that, mostly the market will be doing what? The market will be following that. That is called the psychology of the market. So point number four, so that I can just go on the market and try to point those things that I was talking about very quick. It's apply risk management. So applying risk management, it's talking about actually you manage the risk, right? You manage the risk. We're talking about the lot sizes that you're going to use. You're applying the stop loss. You don't over leverage. You don't open multiple positions. Those are actually part of trading. You need that, right? You need that. So I can maybe just give you some few clues. Apply risk management and trade management technique to your trades. Risk management is the process of controlling your exposure to potential losses by setting stop loss orders, position size, risk reward ratio. So stuff like that. If maybe you know what I'm talking about, or if you don't know, that is something that you have to go and try to improve. Right. So the last point, actually, which is number 5, is a review your trading performance. If you don't have that, sometimes you just go all over the place. You're supposed to know your trading. Actually, this is trading plan. So let me just give you the whole story here. Review your trading performance and learn from your mistakes. Trading is a continuous learning process, and you need to constantly evaluate your results and improve your scale. You can use tools such as Trading Journal, performance reports or feedback system to help you review your performance actually and learn from your mistakes. Because if you don't do that, mostly you end up repeating the same mistakes. If you have a journal, you write your profits or negative, the lot size that you used, why you opened these positions, why you lost this, why you made money on this. That can also help you, so that you will know that I'm not supposed to repeat this type of trades. I'm not supposed to use bigger lot size. I'm supposed to use this. Now you can see that, oh, these are the dons and these are the dos. You can see that, okay, I'm not supposed to do this. I'm supposed to do that, because now you have the journal, right? So let's just make this quick. Let's just make this quick, as actually this video is getting longer. So now let's go on the chart and actually go through everything that I was talking about. Like risk management, obviously it won't be explained on the chart, but maybe I'll try to show you how. So firstly, you identify the trend. So I'm going to talk about this downtrend only here. Obviously, you can see the trend is pushing low. I identified this on a 4 hours time frame, but now I'm on a 3 hours time frame. It's also fine. It's also fine, as I can see that, oh, the market is connecting very nice. The market is connecting very nice. But after you identify the trend, your job is to draw the trend line, just to make sure that, oh, the market is turning around this point. That makes sense, because it shows that these points, they connect very nice. You see, as long as there are points they connect, mostly other ones, they will just come and connect with the structure. You can see we have more than 3 times 3 points where they connect. This is a very nice trend. Actually, it's a very straightforward. Some they can even draw something like this. I don't usually do that because I know that the most important thing here is my resistance area, as this is a downtrend. So this is what I actually do. So your job here is, once you identify that, your job, if you still remember, the point number 2 is to identify the support and resistance. But we know that the market is doing what? The market is going down. We're supposed to look for what? For sales. So this support and resistance, they're going to help us to do what? To get where we can sell. I see the points. You see these points. You see these points. They make sense. That is an area. I see another point here, another structures. If we connect that, they make sense. Those are the resistance. At the same time, that can tend to be a support area. You can see that around this area also we had something. So which means now our job is getting easier and easier. Remember, you identify the trend. Now you have to draw the support and resistance. Inside that trend, now we have this sort of consolidation move. We're going to kill the market or milk the market if we see something like this. Do you see that? Why? Because on a downtrend, we're supposed to do what? Keep selling, which means on the resistance side, we will actually take some sell positions. Once the market bounces back from there, it's where we're going to continue selling. So let me draw those structures that I've drawn before with a proper tool. Now you can easily see that, okay, the market is actually creating or giving me some structures which I can use actually to take trades. Sometimes this can be very thick. The market doesn't really want to make this thing easier for us. I think the next topic will be about maybe the breakouts and the time frames. So yeah, now we have something like this. So you see that, okay, the market is playing around this area and it's bouncing around this area. So that is an opportunity for us to do what? To keep selling. You can see the market bounces around this area, and it makes sense because it's where the market created another structure. You can see, and these areas, they help you to know that we have a lower area and the higher area. Actually, that you can use it as a take profit. So let me show you actually with a proper structure. You can see if maybe we say here the market it's a resistance, we identified that, we're going to have something like this and say, you know what, we're going to have to sell. The stop loss should be a little bit above our resistance, so the take profit should be around this area, or let's say the first take profit, it will be around this area, because we see that it's where the market is bouncing. So it's not like we know only where we're supposed to buy, we also know where we're going to take the profit. If the market breaks, it's fine, but mostly what matters most is we're going to use this area. Oh shit, we're going to use this area. Sorry. We're going to use this area. Let me copy this. We're going to use this area. So you can see we're going to sell, and around this area is going to be the take profit. We just continue like that around this area. Actually, this area we were going to sell, this area we were going to sell, this area we were selling. Also around this point, we're just going to have those. Let me just try to copy this so that you can see. Let's see, around this area also something, around this area it's something. Okay, because this is something that it's a repetition. Actually, we just repeat this. You can see this is what we were supposed to do if you understand actually how to understand the structure. So you can see we have so many trades, 1 2 3 4 5 6. Even if maybe somehow we can take the loss, but the losses won't actually be more than our profits. Just look at this. The reason behind that is you identified the trend, you were looking for sell positions. We don't look for buy positions on a downtrend, right? We don't look for that. So this is something that we all need to understand. And with this structure, the structure itself actually helps you to apply risk management, right? Because you know where the market is bouncing. You know that around this area, it's my resistance. It means my stop loss should be around here. Obviously, it's gonna be wrong. Obviously, you wanna know that when you do something wrong, if you entered here, obviously, you can't make your stop loss to be around that just because you don't really want to lose. Yes, sometimes the market can go and come back, but automatically that it's over risking. Sometimes the market can bounce back and not even touch your stop loss and come back. Then you come in the profit. But that doesn't make you any smart, because some days when the market is going to go against you, you're going to lose more. Rather lose 2% or whatever the percentage that you're using than to lose 50% of your account. So this structure is going to help you, because now you know the resistance. Obviously, your stop loss should be a little bit above, because it's not where the market is going to play around. I hope if you understood this, if you like this video, guys, as I don't really want to make this video very long. I hope you smash the subscribe button. I hope you like. I hope you comment if you have something that maybe you want. If maybe there is topic that maybe you want me to cover, you can just maybe let me know. Thank you very much. This is Kenzo, Xtrahot Forex. Bye.